Hello, everyone. Hopefully you all can hear me. I had a little bit of technical difficulties this morning, so I apologize. You can't see my beautiful face, which will just be less distraction for you. Okay, so I understand that we're all here for different reasons today. My name is Brian Adolph. As far as a short introduction, I'm currently serving as a treasurer for Canton SCORE chapter, and I am also a mentor that specializes in the area of cash flow management. My daily life, I'm a proud father of 2 children. They keep me busy. I have a 3-year-old and a 6-year-old at home. But if I start talking about them, we'll never get to the webinar. So as far as my current work roles, I am a registered investment banker and the owner of Transworld Business Advisors of Canton. Transworld is the world's largest business brokerage and mergers and acquisition firm for Main Street businesses. In my spare time, I write articles for Jackson Living Community Magazine, and my wife and I have a mixable wine business that we run together. In my past, I've owned a mid-sized vending company in Northeast Ohio, a marketing firm in California, and I really just say all of this just to let you know that as far as the information that we're going to be going over today, I've seen my fair share of business documentation in all shapes and sizes over the years, and I'm really hoping that that experience may provide some additional insights and value to the webinar today that you may not get somewhere else. So to kick us off, we have a poll question. Raise your hand if you're responsible in any way for your company's financial management. It's really just a yes or no if you feel you're responsible for the company's financial management. Am I getting those in? So as far as financial management goes, although closely related to accounting, firms need to focus on both areas of responsibility. And really the entire operations, not just folks with titles like CFO and COO, president, CEO, vice presidents, controllers, accountants, and the like. As far as entrepreneurs go, those titles all apply to them personally anyway, but really everyone in our organization is responsible in some way for the data that an accountant would share. So if an accountant is responsible for presenting the financial data, everybody in the organization would be responsible for the creation of that financial data that they're going to be sharing. Is there a way to see the poll or?
In that case, Brian, the polls aren't working right now. So
okay.
I think
I did see that 10 people raised their hands. So,
right.
but yeah, the answer really is that everybody in an organization is responsible in some way for the creation of the financials of the business, obviously. So with that, let's get started. So we've got a really ambitious goal in this webinar, as you can see. We're going to be taking the first step in building a better financial future with your business today. I'm going to be going over how trusted advisors can help you with your financial management and why it's important for a small business, financial management, how financial management practices, rules, and tools work, financial management basics for a small business, basics of startup financing, basics of financing for a growing business, basics of working capital, and basics of fixed assets. So that's a lot in a short amount of time. Obviously, if you have further questions on these topics, you're going to want to talk to your SCORE mentor for further information so they can dive deeper into any of these areas as needed. Next. So many decisions that you make in the business are going to affect you financially. Obviously, one rule of thumb that we give you is that having a strong circle of influence. This is going to consist of your attorney, a banker, a CPA, a SCORE mentor, and a risk manager. When you think about it, you got into your business to share a product or service with the world, and that really needs to be your main focus in your business. Having a circle of influence behind you is going to also help protect you and keep you kind of focused on your main ambition, which is sharing that product or service. If you think about it, it's going to stop you from getting in your own way or worrying about things that may happen, whether your business is set up properly, the banking information is shared correctly, if you have the proper protections and things like that. If you're worried about where things may go wrong in your business, and that these things are not taken care of, you're not going to be able to focus on the main growth drivers of that business. So it's really important that you get the foundations laid with your circle of influence so you can focus less on what may happen and focus more on what can happen with your business. Look at the next. So quality financial management truly offers the benefits to you as a business owner. Financial management includes bookkeeping, projection, financial statement, and financing, obviously, which forms the foundations of reaching goals. Really, it's going to help you to have a clear front view of your business and where it's going to kind of tell the future. Financial management is just one of the main avenues of success. It's the way that you know that you're making a profit, of course, but it also helps you to decide how to move forward with your business, how to make calculated decisions without taking risk, how to truly help your business grow by making, again, those calculated decisions that you're sure of, rather than just kind of throwing spaghetti at the wall and not knowing what tomorrow is going to bring. If your business growth requires financing, for instance, financial management provides the information and the know-how that you're going to be able to afford it, and at what times your business should take those calculated risk, and when documentation is going to be needed for loan applications, and how to discuss those circumstances with a lender, how to know how to have those quality conversations with your CPA and your professionals in your circle of influence as well. Next. So this is a fan favorite of everybody, I'm sure, both personally and in a business. The budgeting often conjures up a restricted mindset as far as what you can't do in business and cutting back. And I think it's important to remember that no business or no one personally in their finances can shrink their way to growth. And so budgeting is essential. But it's also essential to keep in mind when you're budgeting those productivity drivers and where and what to cut and what not to cut. So creating budget really is the first place to start in a financial management practice. A budget is just a list of all your expenses organized by categories. It's a tool. It really does help you keep track of your expenses and plan for the future, economize when needed, plan for expansion. But it also does many more things for you as well. For instance, if you're looking at where to kind of to plan and where to cut back, I mean, it's good to list out all of your expenses, sure, but the key is to identify what type of expenses that you're actually budgeting for. There's 4 primary types of expenses. There's destructive, and those are expenses that actually are harming your business or your brand. And you want to identify those and get rid of those first and foremost. There's consumptive, and these can be categorized as wasteful or overpaying over what may be necessary to optimally run your business. There's productive or protective. These are the things like insurance, your taxes and things like that actually protect what you've built so you don't lose things in a downturn. And then there's productive expenses. And these are all the expenses that actually generate more revenue and expand the growth of the business and expand the means of that budget that you're looking at. So it expands the pool that you're budgeting for in the first place. So as a direct result, anything that you're throwing $1 at that immediately is going to spit out $2, you kind of want to expand that and spend more on that. So when you are looking at budgeting and putting those items down on paper, keep that in mind that it's not a zero-sum game, that it's absolutely a way to track your expenses, but you want to keep in mind and identify those expenses that you're budgeting for. You want to be able to allocate more money towards things that are directly driving those revenues and eliminate those things that are wasteful. Manage those things that are consumptive, because you're going to have some of those in your business. And then, the protective expenses, realize those as a peace of mind fund, you know, to not worry about what could happen in your business, to keep it driving forward so you can keep your eye on the ball and moving your business forward. In addition to the budget, and diving a little bit deeper, I do recommend setting up a banking system also that helps you protect it in your business. So you want to protect your budget as well as protecting your business. Similarly to setting up a personal budget, I'm not to bookkeeping yet, still in the budgeting. So similar to setting up a personal budget where, for instance, you may decide what percentage of your income per month you want to set aside for the future and what percentage you want to allocate for charity and community relationships, what percentage is reasonable for guilt-free rewards, and then managing the remaining amount to manage your bills. Personally, this is the kind of a personal budgeting system that I use in banking system on the personal side. For businesses, you can do something similar by having a kind of a pay yourself first mentality, but instead of pay yourself first, it'd be pay the business first. And you have a pay your business first account set up outside of the operations account. This can be any type of your typical boring savings account or money market account at your bank. And the trick is for every deposit that comes in, a percentage is swept over to this account first before any other bills are paid. My recommended amount here would be 15%, but done is better than perfect. And do something and work up to that if you have to. But there actually is a reason for the 15% number, and that is 3% for business emergency savings, 3% for your propensity to consume. And if you have a team that gets used to doing something it's really hard to cut back on, it also handles kind of that inflationary effect in a business when, you know, people get used to things and things just start costing more in the business. 3% for planned obsolescence, because things in a business they're going to break, they're going to become outdated, and then 3% for technological change. That makes up 12%. Now the last 3% of that 15, I think is good to actually break that off into a separate checking account, and that creates a reward account for a business, kind of your slush fund or your things are going good. Those are for big screen TVs or a pool table or, you know, camaraderie at the business or new coffee makers, you know, things to increase morale that you don't have to necessarily, you know, worry about, but more as cash for a consumptive expense. And by doing this, proactive.
Hey, Brian.
Yeah.
We have a question from Belinda. She is asking if there's a slide with the names of those expenses and their definition, kind of like a chart of accounts, maybe kind of a thing. Can you, do you have a slide for that, or can you talk to it?
I can go over those again. So you have destructive, right, which is obviously going to destroy, you know, anything that's going to harm your business or brand. And there's only four. There's consumptive. So you think anything that is that you're going to be spending, and those you should manage kind of with that extra cash sort of things. Those are those morale builders. Those, you know, things are good for a business, but not necessarily investments in the business. Protective is anything that you foundationally are making sure that you kind of keep the mark and are protecting what you've built. And then productive, those are the expenses you actually want to increase in the business because they're building your business and they're growing and expanding the means of the business. So it's destructive, consumptive, protective, and productive. And I do apologize for going a little bit off slide.
So did you answer Belinda's question? Is there a slide with a list of accounts?
No, I do not. This is kind of the CAP version that we had for the financial management that we got from SCORE.
Okay. There's probably, you could probably Google like an example of a chart of accounts, I would imagine, right? Because it's kind of, it changes with your business type to some degree, right? So Belinda, that's what I would do. I would go to Google or, you know, AI and ask for a typical chart of accounts, and I think it'll give you what you're looking for.
Yeah. And generally, this is going to be different for everyone in everyone's business, and that's kind of, you know, that's important to know. And when we're talking about budgeting, there is no one budget for anyone's business, because everyone's business is going to be personal and different, and how they manage that budget is going to be different, because what one person spends on marketing is going to be completely different than what another business spends on marketing, because it's a different, it's a different target audience, it's a different product, it's a different category. You also have to consider the team players and the wages and things like that. If you've got, a once in a lifetime person that you're working with and you're paying them 5 times more than anybody else would in the marketplace, however, they are driving your business and the business growth, how do you put a dollar amount on that? So if they're being 5 times more productive, and that they're directly tied to that revenue, that's a productive expense. So you kind of have to look at what's drawing the business down, what is actually hurting your brand, what's a destructive expense, what is being consumed, is there anything you can save on? Typically when we're looking at budgeting, people are looking at those consumptive expenses and where can they save and where can they cut, and everybody is leaking some money out of their business. But that's just, that's a small portion, of a business's expenses is, those consumptive expenses. You also have to look at where you can kind of expand, that chart of accounts, if you will, and where where you can have more money to budget. Because again, you can't just save in order to, increase the top line. Yeah. Now, as for the how to set up the kind of the pay your business first in general, if you have a savings account or a money market account and you're transferring over 15%, it'll cover your emergency savings, your propensity to consume, planned obsolescence, technological change, all those things. You don't have to know exactly what all that's for. It's just your business has cash, which will give you some kind of a peace of mind for those things, and know that that's kind of taken care of. So you're not taking all out of your operational fund. And then you pull 3% out of that, which can go to rewarding yourself and rewarding employees of the company as kind of your guilt-free spending for the business. That's kind of a pay yourself first mentality on a personal side of budgeting, but more on the business side. And then from there, I do recommend actually having a separate checking account for paying vendors and then for paying payroll. And if you look every week and you have your vendor payments going out one week and then the next week you have your payroll coming out, you can at least eyeball to see those changes and knowing what's coming out of that main operational account on a monthly basis. So you can kind of see when those are dramatically changing one way or the other as well.
So Brian, you're recommending like 3 checking accounts, your personal, one just for payroll, and one for, your accounts, your receivables and your expenses?
Yeah, I would actually recommend having an operational savings. Everything goes into it. And the reason for savings is just because these are where deposits are going to be coming in for most business types, right? I mean, it kind of depends on what type of business you have. But you don't want something that anybody can pull money out of that has a routing number, an account number that somebody could write a check out of or get a hold of those numbers. So if you have your operational account is set up as a savings account of some type, you don't have that concern. And usually you have the ability to make, 5 withdrawals or so on a savings account without, on a business savings, without getting any kind of fees or anything like that. I would recommend paying your vendors on a if you can pay them every 2 weeks and pay your payroll every 2 weeks and have those kind of alternate. You can level out the amount of money going out of the business. So that way you're doing payroll one week and you're paying vendors, the other week. And there's ways to do, that you can do that strategy wise. So you can kind of have some additional cushions and whatnot, but it is good on the budgeting side. So you can see, these are my vendors, these are my vendor payments, these are my payroll payments, and this is what they usually are. And so you can kind of track those sides. So as far as the bank account setup though, I would recommend one operational account for savings, and then you would have your pay yourself first business account that is taking that 15% off the top. Then you have your 3% kind of reward account off the side, and then you'd have a vendor account and a payroll account. Now, the one that you're actually looking at as far as the operations of the business that handles everything else, you're going to just be looking at the operational savings, which has anything that's left over from, from the business outside of that's going to have kind of your retained earnings and whatnot in it. And from that, you pay, you can pay draws and things, all the retained earnings and everything from the business would stay in there. And that way it remains protected as well. So there's less chance of any compromised routing and account numbers on the vendor side or the payroll side, or, anything that somebody had the ability to draw money out of. That's not you. Okay. So hopefully that is helpful. So, I mean, number of account wise, there's a number of ways, that you can do this, but the important thing is that you have a system in place that makes it easy for you to kind of track those expenses, to pay your business first and know what those expenses are, that you can kind of look at them and be able to manage those 4 types of expenses that we discussed. So even if you're not going line by line, identify the types of expenses that you're dealing with and have a plan to address them, because failing to plan is planning to fail. Is there anything else on the budgeting that would be helpful at this point?
Hey, Brian, I'm not sure when the next poll question is, but polls definitely isn't where the function isn't working today for some reason. So if you do have a poll question that you want to ask, they're going to need to put their answers into the chat.
Okay.
If you want to see them, okay? Sorry about that.
All right. No, you're okay. Okay. So now that we've talked about creating a simplified budget, and that we're not only cutting everything down to the minimum, and that's not, the point of the budget is to grow the business. Let's move on to bookkeeping. So bookkeeping involves recording and classifying all the financial transactions in the business. It's keeping track of what your business spends and what your business receives. These tasks used to be managed using books and ledgers, and that's why it's actually called bookkeeping. Originally, transactions were recorded in day books and cash books and journals, and then transferred to a ledger. Now, bookkeeping software, even banking software, takes care of most of this for you. So there's not really the need to keep track of everything on the paper books anymore.
Hey, Brian.
So in book, yep.
Brian, we have a question from Paul about the recommended percentages. Are they based on gross sales or gross profit?
Yeah, anything that comes in. Yeah, anything that comes into the business. So before you take anything out.
So it'd be gross sales then. Okay.
Yeah.
Laura,
and like I said,
Laura, go ahead.
Yeah, obviously 15 is a goal that can be hard to get to. I mean, and you definitely want to cut down things and see where you can manage. But if you can start off that way and you can move forward from that and do pricing accordingly in the business, and it really provides a peace of mind in moving forward and pricing accordingly, that that the business is taken care of on the back end.
Okay, and Laura has another question. She would ask if you could please review with quick points. I'm not sure what she means by that. I can kind of talk with her offline and see what she's looking for, unless she wants. Okay. There you go. Okay, so Mary Lou is kind of asking for a recap of the 3 banking accounts. One's for operational savings that doesn't have a routing number. A second would be your pay yourself account, 15% of gross sales off the top. And the third would be payroll vendor savings account. So she's asking for verification of that.
Yeah, okay. So you'd have one savings account that everything goes into. That's your primary operational account. From there, you would sweep 15% into the pay yourself first, or your pay your business first account. Out of that pay yourself first business account, 3% of that 15 is actually just for your, your business is, you know, give yourself that guilt-free spending. So really it's only 12%, and then 3% can be spent on goodies for the business. So if you want to break that off as a separate, you know, checking account, you can do so, or you can just know that 3% is allocated in that account for that type of spending, whatever, you know, works best for you there. I recommend having, if you have Paychex or you have a payroll provider, you don't need a separate account for, you know, for the payroll, because they provide checking accounts or they provide checks to employees with a separate checking account and routing number on it. So you don't need that, but I do recommend having a separate account just for vendor payments, because you don't want to be giving your vendors access to your operational account in any way. So savings accounts, they do have a routing and account number, but they're not, you can't, somebody would have to go into a bank to make a withdrawal on a savings account. Unlike somebody making up or copying a fraudulent check and presenting as a payment at a bank or as an ACH wire or something like that. ACH wires come from checking account and spending accounts. So if your operational account is in a savings type of account, it'll protect your retained earnings that way. And most of your business funding and everything building up in there, and you'll earn a little bit of interest on it as well. So hopefully that helps answer that. All right, so on to the, as far as the bookkeeping. And a lot of banks, and I would talk to whoever you bank with, a lot of times they have this, this ability for business checking accounts and things that can help monitor the cash flow and whatnot of the business if you're running your business through that bank account, through that business bank account as well. There is software like QuickBooks. There's also additional you know, software and services. There's a lot out there now that, you know, on top of the bookkeeping. I know there's a company, I think it's cashflowtool.com, that actually sits on top of everything that's in QuickBooks. If you do use QuickBooks, that helps on the cash flow side as well. So the documentation has got a lot easier for businesses, especially not needing to, you know, kind of do all the heavy lifting and the math and keeping, you know, the books and ledgers and, you know, balancing everything yourself on the bookkeeping side. Most of this can all be done with QuickBooks. With Wave, there's a number of different. Sage has, you know, there's a couple you know, free options out there as well. And like I said, and banking software has gotten more and more financial technology inclusive, you know, because banks are competing for that market as well, and it's really been to the benefit of businesses to kind of take them up and include learning some of that technology to manage their bookkeeping in their business as well. Next. All right, so here there are two terms in bookkeeping that we're going to have to bear in mind and familiarize ourselves with, and that is cash and accrual. So on a cash basis, a business recognizes income and expenses when they're actually paid or received, rather than when the product or the service is delivered. So if you think about invoicing for something, it's when you're actually getting paid for a service being done or a product being sold. On the accrual side, it recognizes income and expenses when they're actually being acquired rather than when they're received. So if you buy inventory and you have to pay for that inventory before it's put on sale, and then the business carries that inventory for a while and then it sells it, that would be an area that would be more indicative or something that should be done more on an accrual basis. And in fact, the IRS does require at some point to be on an accrual basis if you are carrying extensive inventory for bookkeeping purposes. And the reason for that is because it really can dramatically affect the numbers, especially at year's end. And it used to be a lot less so now, just because the float with electronic payments nowadays is far less, and tracking those things is more difficult. But I run into this with my business oftentimes, where they'll do a job on a cash basis in, say, November or December, but then they won't get that, and they'll have all their expenses accounted for doing that job, which will completely take away from the profit of the business, and then they won't get paid on it until January or February from that job. And if they're on a cash-based accounting method, then their statements aren't going to look so pretty, because they'll look like they lost all that money that year, when in fact they're just waiting on the payment to be made. So, which kind of brings up the key differences. So on an accrual basis, your revenue is recognized only when it's earned, and on a cash basis, it's recognized only when you actually accept the cash. On the accrual basis, expenses are when are recognized after the final payment is made, and then as taxes, for tax reasons, as I just mentioned, it can go the same way, which is why, like I said, at some point, larger businesses especially are kind of forced to go to the accrual method, just because they really can play with the numbers, especially at year's end, in that last quarter, if they're going to be accepting money for jobs that were done in October, up to February. It looks like they really didn't make anything in those months because they had the expenses, but then didn't, get the payments on those jobs until the following year. So accrual basis, just to kind of mention, it combines two key accounting principles: the matching principle and the revenue recognition principle. As far as the matching principle is, really the expenses should be recognized in the same period that the revenue that helped them to generate. And the recognition principle states that the revenue should be recognized when it's finally earned or realized. So when a business performs the action that entitles them to that revenue, the accrual accounting generally makes the relationship between the revenue and expenses a little bit clearer, especially when it's spacing things out rather than an immediate sale. It's a lot easier when you buy something, you sell it. You buy something, you sell it. On accrual, it makes it easier to understand the relationship if you have annual or multi-year contracts, membership subscriptions that are not paid in a lump sum up front. They're paid over a space of time. Another example might be expenses that are spread out over multiple periods, such as a contract for payroll vacation for employee benefits that actually accumulate over payroll cycles for the company. So each expense really is just during the period that it applies to, even though it pays the expense later on. Utilities and rents that are billed after a period to which they apply are similarly handled on an accrual basis. The company accrues the expense during the period that it uses those utilities, so they can kind of divide them out. Income taxes, similarly, the company recognizes taxes during the period that it recognizes the revenue, even though it's going to pay that tax bill later on to the IRS. And interest on loans is recorded during the period that the principal is outstanding, even though that's going to be paid later on as well. So when you're using the accrual basis accounting, most investors and lenders and financial institutions will look for this as a general accepted accounting practice when evaluating business. And the reason that it's more prevalent, especially in these businesses, is that anytime a business is above 25 million in annual revenue, it's going to be the law that they have to use the accrual basis. Lenders require this method oftentimes, just because of the consistency of the key matrix, that it makes the business look more stable and it increases the chances of receiving funding because of that stability. Additionally, accrual accounting makes the general accounting practices compliant for a business because it is a best practice, and it could be important down the line. Even startups that start out on a cash method, due to the simplicity of, obviously you pay for something and then the customer pays you, it's pretty transparent. They tend to eventually move towards the accrual basis, all for the reasons that I just mentioned. So even if you don't follow the standard now, you may want to at least familiarize yourself with it for the future, especially if your business starts to increase handling inventory and as far as revenue, expenses, and accrual. If your business relies entirely on cash payments, then accrual accounting is not probably going to be the best fit. However, if you do start to handle more and more inventory and holding things up, then it obviously is going to, because the cost of goods is not going to be accurate moving forward from year to year if you're holding that inventory on tax returns. And I actually have a good an example of the cost of goods that can be thrown off on this as well, because a lot of times there was a boat dealer in Florida, and every year to kind of not pay taxes on the revenue, every year they buy more engines, and they just keep buying more engines at the end of the year to put towards the inventory. So they carry that inventory. Unfortunately, the inventory didn't make it to the balance sheet, which we'll go through later. But they ended up with a lot of inventory, which look like, moving forward, what do they do with those inventory and that supply moving forward? Because anything that they would be pure profit, if they didn't count that inventory moving forward. And it really, like I said, it just kind of, it throws the numbers off. I mean, it can sink the gross profit of the business on paper, but then again, also moving forward for the business, it can throw things off if you're not recording things accurately. So that being said, most smaller businesses, they prefer the cash basis. It is simpler. It's pretty transparent. Bookkeepers, they'll start off using this, but again, it's good to familiarize yourself with the accrual basis and kind of the benefits and downsides.
Hey, Brian.
Moving on.
We have a question from Jeanette. For a service business, should or can income be spread across months worked? Once across months work if is completed rather than when the payment is made at project complete with let's read this again. For a service business, can or should income be spread across months work is completed rather than when the payment is made at the project's completion with an accrual basis? I guess, can you spread your income? Can you accrue your income? I guess is what she's kind of asking, or should?
Yeah, I mean, and that depends. So that's a strategic question. You should talk to your accountant about. It can be handled either way. Where it gets tricky is, kind of how you want it to strategize in the years moving forward. So if you quoted a job and let's say it's a 3 or a 5 year job, and you are going to charge them every month for the number of years moving forward, that's going to be a consideration, because you know that that's a job outstanding. So then it would be a consideration whether you want to consider that revenue or a liability on the book. So if you handle it just as a cash basis and that it's not a contracted amount moving forward, then you don't necessarily have that as a guaranteed payment moving forward. And that's kind of, I guess, the positive and the downside of considering it accrual or cash basis in that specific instance. Now, if it's just an ongoing payment, then it's not really going to affect things as much if it's just kind of a monthly subscription, and it's small enough. It won't really affect things as much as if it's a contract for a certain amount, spaced out over a longer period of time, if that helps. Okay. Hopefully that helped answer that question. And we will let's look at the next slide. We'll go into financial statements. So we're looking at financial statements and how to manage your business. It's important for business owners to become familiar with their company's financial statements and how to use and manage them, use them to help them manage their business on a regular basis. Financial reporting is done right, then you'll get a complete picture of your company's finances in regard to your revenue, expenses, your profit, and your cash flow. So what is financial reporting typically? When we talk about financial reporting, we talk about the three statements. We talk about the balance sheet, the income statement, and the cash flow statement. These three statements are actually interrelated. For instance, the balance sheet is a snapshot in time of everything that the company owns and owes. It's the equity of the business, then in between one balance sheet here to the next. And then we have the cash flow, and the income statement really describes the accurate actions that change from balance sheet from year to year. So more specifically, the income statement will show you what's happened and why your equity has changed from one balance sheet to the next. And then the cash flow statement, on the other hand, it's going to demonstrate what happened to the cash. So what happened to the cash on the balance sheet from one to the next. So therefore, those two statements, they're the documentaries, if you will, from one time to the next, in between balance sheets. So the income statement documents the equity changes. The cash flow statement documents the cash changes. And the balance sheet is more the whole picture. So if you want to know what's changed on the balance sheet related to cash, you would look at the cash flow statement. And you want to know what's changed in the balance sheet in regard to equity and income, you would look at the income statement. Now, I know we have another poll question, but the polls were not working correctly. So I believe the question was in regard to draws. And if I remember right, the question was, when is it okay to take a draw on a business? 6 months, 2 years, or any time?
Yeah, please respond in chat with what your thoughts are regarding this question. I'm not seeing any responses, Brian. So
Yeah.
why don't you go ahead and add,
Okay.
if I see any, I'll throw them out to you.
Okay.
One, add responds with any time you want to take a draft, you should.
Yeah. So I mean, there's a lot of confusion about draws sometimes. Is it considered income? Is it is it a paycheck? Is it payroll? And really, a draw is just it's a withdrawal from the profit of the company. As long as there's money, as long as there's profit from the company, you can take it anytime you want. Now, you have to understand that that's going to be taking money out of the business and technically the profitability of the business. But yeah, if there's money in the business, you can take a draw anytime that you want because it's the business's profit and it is available to you anytime. Now, how you want to set that up, again, whether you're paying yourself as a draw, there's tax benefits to that. But would you like to show a more profitable company, or would you like to show, that you're taking more income for yourself? So it goes to you or it goes to the business. Doesn't really matter. It's the same amount of money. You've already kind of accounted for it as profit. Either way that you want to look at it in the business. Okay, so more on the financial statements. I gotta move my computer. And my slides got mixed up. Okay, so we're moving on to the income statement. Yep. The income statement actually tells you how much money the company has brought in as far as its revenues. how much it expenses, and the difference between the two, which is its profit. The income statement has a basic structure that generally starts with the revenue and the sales made. Then you subtract the cost of goods sold or the cost directly related to the sales themselves. From there, and we're I don't know if we can zoom in on the, if it's on the next slide. From there, we'd end up with the what we call the gross profit. Next, we could subtract out the operating expenses, or what some kinds call the selling or general administration expenses. Examples are wages and marketing, and also include the cost of depreciation. So if we subtract out those things, we would get what is referred to as operating profit, or EBIT. A lot of people consider the EBIT number as a big number, especially in lending. If you're going to sell your business, they may look at the EBIT number for evaluation purposes. Next, we can deduct the interest expense, and then we'd have the earnings before taxes. If we deduct the taxes, then that's when we get the EBITDA number. It's profit. Profit in simplest form is just equal to the revenues minus the total expenses. However, there are several commonly used profit subcategories, as I just kind of mentioned, that investors should be aware of, and the growth profit is calculated as revenues minus the cost of sales, is basically shows how much money is left over after paying those operating expenses, as kind of broken down. And hopefully there's profit in the end. So operating profit is equal to the revenues minus the cost of sales and operating expenses. This is the number that represents the profit a company made in its actual operations, and it excludes certain expenses and revenues that may not be related to central operations, because people run businesses in different ways. One really important thing that you can read from an income statement is the company's profit margin. So if you, let me see what's the next slide. Nope, that's not it. Go back to it then. On a typical income statement, if you wanted to know the profit margin, you just divide the bottom number by the top number, and the net income generally represents the company's profit after all the expenses, including the financial expenses, have been paid. And the number is then called the bottom line, and it's on the bottom of the income statement.
Can you repeat that, Brian? Can you repeat that?
Yeah, so I was trying to look for an example of an actual income statement, rather than what we have there. But it's obviously, if we want to know what the bottom line of the company is, we want to take the revenue minus the expenses, and that's why they call it the bottom line, because it's the profit that's left over. It's the net after everything's been taken out is the bottom line. If you want to know the profit margin, you just take the top number and divide it by the top. Or sorry, the bottom number, the net profit, and divide it by the top.
So this is an income statement of a pretty healthy company then?
Yeah.
Okay.
Yeah, I can bear that. Yep. All right, let's move on to the next slide. And we can go through the assets and liabilities. Okay, so as far as the balance sheet, it's just a financial snapshot, as we mentioned, of everything that the company owes and owns. The difference between what the company owns is called the shareholder equity. I like the fact that they call it shareholder equity, because a lot of people can kind of relate this to a mortgage, as far as their understanding of shareholder equity in a business is very similar to when you have a mortgage and you're paying on a house. You have equity in that house. As you make payments towards it, you have more equity. Very similarly, shareholder equity is the net worth that the owners have ownership in the business in general.
Hey, Brian. Brian,
yep.
Can we
Yes.
take a step back to the previous slide? Mary Lou missed something. She asked that you repeat apparently, and this is in quotation marks, if you want to see what has changed on income, look at the income statement. Then she missed the next sentence. Look at balance sheet to see what changed in cash flow. Is that what the statement was?
Okay. No, so the thing to keep in mind on your balance sheet is going to, your income statement is going to be the changes that are taking place in time, and your cash flow statement are going to be the changes that are taking place in set time. Your balance sheet is more of a so those are changing. So a point in time from one balance sheet to the other are kind of fixed snapshots. So if you look at the balance sheet at the first part of the year and the end of the year, then you can look at the income statements and the cash flow statements throughout the year to see kind of what happened to the cash and what happened to the equity to make up those changes in the balance sheets. So if you want to know what happened with the shareholders' equity on the balance sheet, you look at the income statement throughout the year. If you want to know what happened with the cash on the balance sheet, you'd look at the cash flow statement throughout the year. But the balance sheet itself only changes when the income statement or the cash flow statement change. So if you want to know kind of why those things change, you have to look at one of those two other statements. Does that help answer the question? So again, the balance sheet is just a financial snapshot at that point in time. You take two of those and you want to know what happened from one to the next, you would have to look at the income statement or the cash flow statement. One's going to show you what happened with shareholders' equity, and the other is going to show you what happened to the cash.
Thank you, Brian. I think you answered her question.
Okay. So on to the next. And so there's a lot in this presentation. So just touching on a lot of these things, and I know there's going to be more and more questions, which is why it is important to work with the SCORE mentor and some professionals in other areas, because it's going to spark some conversations and some ideas, and want to kind of know more about these things and what we can obviously cover in an hour to an hour and a half.
How many more slides do we have, Gwen? Any idea? It's 11 o'clock now. I just want to do kind of a time check.
Yeah. There's a number of more
The
slides.
answer is lots.
Yes.
There are lots more slides.
Okay. All right.
Let's see what, and we can maybe skim through some of these things. I do want to kind of explain as far as the assets and the liabilities equaling equity. So this is kind of one of those important ones for people to kind of understand. And again, if you understand kind of how a mortgage works, it does help kind of answer that question. Where yes, you own your house, but you own more of your house as you pay off the mortgage, and you own all of your house in the end when everything is paid off. As far as assets and liabilities, the other thing to kind of keep in mind is the sides on the assets and equity always balance out as far as the left side and the right side, liabilities and responsibilities. So I'm trying to think of how to kind of wrap all this a little bit quicker up. So shareholder equity, it's the net worth of the business. And it shows what the owners actually have invested in the company as far as the overall value. And then we can talk about the balance sheet after that. If that kind of let's move on to the next slide. Okay. Yep. So this is the balance sheet. So as you can see, the left side has totals in the bottom. They're going to equal the exact same amount as the right side, which has totals on the bottom. And this is always going to remain true. You're always going to have the assets and liabilities on the income statement kind of balancing out. So the left side and the right side is always going to remain the same. This is an example of an income statement. Or sorry, yeah, I guess we can. Let's move on to the next one. Look at the income statement. Okay, so this is an example of an income statement should look like. An income statement is just one of the three financial statements. It reports the financial performance of the business over a specific period of time, and it shows the comparison, obviously, over the last few years is the example that this one shows, which, if you want to know more of kind of, how those decisions are being made and what things are being spent on, you can, dive deeper in the income statement. Okay. Let's go ahead and move on to the next slide. Do the statement of cash flows, because this is an important thing to kind of cover that often gets overlooked. So 82% of business owners don't feel like they have the cash of their business under control. So, financial statements aside and kind of understanding, the statements and how those things work, I think cash flow is the most important thing for a business because it's the lifeblood of a business. And so I think it's really important that we have that under control and have a good understanding of how to get that. You can always pull a cash flow statement from accounting software like QuickBooks. Also, if you can just print out, and the cash flow statement itself, it shows all the entries and expenditures for cash in a period of time. It allows the management to see how the cash is, being added and subtracted for operations. We understand all that, but a lot of times a business owner will get to the end of the month and say, where's all my money? And then they'll look at the cash flow statement and it won't make a whole lot of sense. And then they'll start diving into each and every other expense. And then they'll, go back to their budget and, seeing where they can cut. And that's where the minutia of the financials usually, start to get difficult for a lot of business owners to wrap their head around. And then they start, looking for, experts and trying to explain these things. So I think one of the easiest things to kind of, at least so you can get your finger on the pulse of the cash flow of a business, is to have maybe just like a cash flow report or just kind of a snapshot of, kind of what cash is going in and out of the business. It is helpful if you are, again, only paying vendors once a week and your payroll's coming out, on the alternating weeks and things like that. So you can kind of see those changes. But also if you print out the general ledger, or if you look at the general ledger, which is your chart of accounts and, everything that's being spent on, in the business, and you just look for the three biggest movers every month. So every month, just look at, what happened in the business as far as cash moving in and out of the business, and you circle whether it's good or bad, doesn't really matter, the three largest movers, and you make a circle around those three things. Make a little note that says whether that movement was good or bad and what the explanation was from it. You'll have kind of a feel of, what happened, and maybe you won't know what it was from, but then you can dive a little bit deeper and say, what was this large expense? What did it happen from? And you can look at correcting that for the following month. The nice thing about doing things this way and looking at this on that cash flow basis is you'll also be able to have an intelligent conversation with your banker or with your accountant. If they ask how things are going, you'll immediately, for the month end, as far as a month review, be able to say, well, you know, cash went down for the month because we had a large project that we just started. So expenses, we had to pay for those. We'll get paid for those in the following month. We also had, you know, we brought on some additional employees, which also took a bit more of expense. We expect those to be, you know, more productive in the month ahead. And our cable bill, or, you know, another expense went up. So you can kind of explain what happened to the cash. Or if you had a particularly good month, you know, you can explain that too, because you had an anomaly of, yeah, we got paid on a job that we did 2 months ago. However, you know that the following month, you're probably not going to get paid on that big job from 2 months ago again. So it helps you to forecast and have, you know, kind of put your finger on the pulse of your business, and just focusing on, rather than trying to focus on everything that's going on in a business, maybe just the 3 broad things as far as the broad categories that are going up and down in the business. And that'll also, and then you can look at the cash flow statement. And it makes a lot more sense then, because you can see what's really going on, and all the minute details, they don't matter as much. It's a simpler formula and a way to look at a cash flow statement. So I think on the next slide, we have what a cash flow statement actually looks like. Yeah. So again, I feel like, you know, sometimes it can be overwhelming to see, you know, what's actually going on in the cash flow statement, but you can do this from the cash flow statement. You can do this from a general ledger. Anyway, you can do this from a bank statement. You can do this on just about anything, any way that you can see what actually happened to the cash each month, and just go ahead and circle cash went in, cash went out. What was the 3 biggest movers and why did it happen? And then go ahead and make a note whether it was good or bad and what happened to it. As long as you can understand those things, you'll fundamentally be able to understand your business a lot better. I know it is after 12 now. I'm not. How is everybody feeling? Because I know, like I said, we have a lot in this webinar, and I know I could, you know, I could.
Brian, right now you still have 18 attendees listening in, so. Just want to remind everybody that they will receive a copy of the PowerPoint, and if once you receive it and you look at it or listen to it and you have questions, you'll have your information to call SCORE, and hopefully we'll be able to answer them. Looks like we have a couple questions, a chat. Let's see. I think Claire is just saying there's a lot of information, and thanks you. And then there's a couple questions here. Let's see what they are. Overwhelmed, hurried, helpful, a lot of information, which I think we know. So again, if you receive the PowerPoint and you see questions, please don't hesitate to give SCORE a call. Brian, is your SCORE information in here anywhere? Your personal SCORE information that they could contact you directly?
I didn't know if it was on the first slide or not, but it's my first last name.
Yeah,
SCORE
so it'd be
Volunteers.
Brian. Yeah, so it'd be brian.adolf@scorevolunteer.org if questions come up. So, which I'm sure they will. Let's see, we got a couple more here. Yeah, overwhelmed, a lot of information. Very helpful, but a lot of information. So, your call. You still have 18 people that are listening. So.
We can kind of if we want, we can try and slide through some of these others, and I'll go off script a little bit and see, you know, some pertinent information from some of the slides remaining, because I know there is a lot remaining here.
maybe you could just cherry pick some key points off of each slide, maybe.
Sure. Yep. So we kind of mentioned that the gross profit is the revenue minus the cost of goods sold. The operating, is the gross profit minus the operating expenses and the net income. I kind of covered that earlier on the income statement, which is also the profit and loss. Now, something else to kind of keep in mind when on the profit and loss and those things is if you're looking at building a value of the business to potentially sell someday as well, how you kind of handle these things and the tax implications matter as well, and draws matter. Because certain things can be added back. So you want to also consider what is necessary for a business and the different types of strategic buyers or something that in the future that may not need certain expenses. That's not necessarily. I don't want to get into all that. I was just thinking as far as because of this interest and taxes and depreciation. Although it makes up the EBITDA numbers, there are other things that expenses in a business which often are added back and added back to the value of a business if they're not going to be necessary for another business that might be taking over in the future. Okay, what's the next slide? Okay. Yep. So there's a number of tools and availability out there on the business financing. So you do there are many ways to get funding into a business, and I know when I ran my vending business. It was a very capital intensive business, and I really did. I never took on a loan, and I always look at debt as being a bad thing. And I never had a business credit card, and I know that's something that a lot of people strive for as well. But if it is used responsibly, and it is a tool, it can be considered a productive expense as long as you know that every dollar being spent is going to spit out $2 in the end. So as long as you can classify it as a productive expense, it can be a way to grow a business. So there's a number of different ways that you can kind of leverage the equity and the assets in a business. There's asset financing, which can, you pretty much you put the you can utilize the assets in the business in order to get cash flow. There's lines of credit. There's different things they can put up. Home equity lines of credit can also be used a lot of times, but that's putting your house at risk. There's different assets that you can put kind of up, at risk. So again, there's kind of a risk profile along with anything, anytime that you take a debt instrument on. So you kind of want to balance that out as well. But sometimes businesses need money to grow. And there was a number of opportunities, and there was a number of times in my past where I had to pass up opportunities to grow my business because I did not want to take on financing. So I had to pass up jobs that I couldn't afford. So again, look at business financing and kind of the risk in it. But if you can determine that it is indeed a productive expense, you may want to consider it as a productive tool to utilize and talk to a banker about the number of ways that, options that could be available for that. And not necessarily related to this, but I am an advocate of business credit cards now. It took me way too long in my career to kind of realize that those the cashback points and the things like that give a little bit of benefit. However, on the cash flow side, which I mentioned before, if you have two business credit cards, just two, and I mentioned I like to pay vendors, let's say on the 12th and the 24th of the month. If your vendors know that they get paid every 2 weeks, and you let them know that that you pay vendors every 2 weeks on that schedule, almost like your payroll, then you can use pay off one credit card on the 12th, which statement period ended on the 11th, and then you can pay off the other on the 24th, which statement period ended on the 13th, and you have a guaranteed 45 days of a grace period kind of built in, just because the credit card has a 30 days plus a 20-day. So you have your statement period, then you have your grace period. So you have interest-free financing kind of built in with every time that you pay vendors, which just gives you a cash flow buffer on receiving funds from your clients. So as long as you can work that out with paying vendors with a credit card, you can usually guarantee payments to them a little bit faster. So sometimes you can cash in on those early pay discounts. You can get the rewards points for the credit cards. But on the cash flow side, you can guarantee yourself 45 days of interest-free financing without going to the bank or relying on other financing tools. Okay, what's on the next slide? Business financing. It's banks are the most conservative organizations in the world, and so they don't take bets. They only take guaranteed sure things, and we should kind of learn from that and know that in our own business. But if you're going to be going to a bank, having your ducks in a row, working with a SCORE mentor to make sure you have a business plan in place, and that you can present your plan and present it assuredly by knowing these statements and things like that. It's important. Let's see what's on the next slide. It's important to on the business lines of credit. So your personal credit and your business credit is different. There are separate agencies that look at a business credit. You can create a free DMB profile at I believe it's dmb.org. Which is done in Bradstreet. So that's the largest credit reporting agency for businesses. Experian also has a credit for businesses, but you want to make sure that you're registered with the business credit reporting agencies, not just their personal. So you're not personally guaranteeing or personally assigning for each credit. You also want to check with different organizations that report and rely on business credit, vendors that rely on business credit rather than personal credit, and if they report. So I know that I had three vendors that I preferred to go to because I knew that they checked and reported just to the business reporting entities, which I would use more so than other vendors because I knew it built kind of a value that I can cash in the future for financing when somebody's going to be checking my business credit. I know OfficeMax or Staples was one of those, and having something with them. Granger was one that was fairly easier to get credit with, that also reported to the three major business credit reporting entities. But the important thing is you want to start building business credit, not just personal credit. Let's go on to the next slide. But nowadays, every bank is also going to be looking, especially for entrepreneurs, their personal credit score, and the loan to value ratio that they're going to be looking for is at it changes, but the equity relationships, I know in the SBA is 1.25, but they're really going to be looking for the conservative repayment ability, and with any other loans outstanding out there, that they have the ability to make payments if they were to take out another loan. See what's on the next one. So the SBA, there's been a lot of changes in the last couple of years with the SBA and with business lending. Now with the new the SOP, which is the the procedures that they follow. They've really deferred more to the bank's lending procedures, which means they're telling the banks, if you would make this loan to a business customer on your own, so not an anomaly, then we would go ahead and back the loan with the SBA assurance or guarantee by your own credit kind of guidelines. So that opened up a lot, as well as the real estate now. If a real estate is worth 51% of a loan, so if you go in and you're even refinancing a loan for a business, the business loan amount and the real estate amount, and you're taking out a loan for the business and the real estate, if the real estate is worth 51% or a greater amount of that loan amount, you can amortize it over a 25-year period. So where most businesses are taking 7 to 10 years on a loan and paying a higher rate because it's a shorter loan, a lot of times they can include real estate, on that now and spread those payments out. And sometimes actually the payment amount is actually less than what they're paying just for a business, and they'd be able to get an asset that's going to be growing as well. So that's one of the changes with the SBA. So it's a lot of times it's a good time to look at if you're in a building possibly and you're paying on a loan for a business, or if you're buying a business, to look at acquiring the real estate that goes along with that premise as well. Next. Okay, I stopped looking at my notes, so on this, but I believe we are to the final slides of the presentation. And hopefully everybody learned a lot from this. Financing. Yep. Thank you and good luck. Was there any other questions? Anything that I can cover more in detail? I apologize for skipping around, and I hope I provided some kind of value for you all and didn't confuse you deeper.
Not seeing any, at least right now, not seeing any more questions. Let's see. We do have, let's see. No other questions.
No, okay. All right. Well, thank everybody for joining me today.
I think we have one more of these. When is it, Gwen? Is it next week? I'm trying to look today.
It is the 27th.
The 27th is the
Right.
last one, and our presenter is Joe Belinsky, and he's going to talk about growing your sales, which is pretty important to everyone that's on the call, I'm sure. So Mary Lou, I hope that answered your question. So. Okay, I don't see any more questions, Brian.
All right, thank you. Thank you everyone for allowing me to do this.
Yeah, I want to thank you, Brian, for your time to prepare for this, and for those of you that listened in. I'm sure it was a lot of information for many of you, and like we've alluded to in the past, if you have any questions once you get the presentation in front of you and you listen to it, if you have any questions, please use SCORE as a resource. We would be glad to help you out. So let's see, Mary Lou. Mary Lou, I'll try to, let's see. If you give me your email address, I'll make sure we send you the invite. So let me just send. All right. Oh, there it is. There it is.